Welcome to Questioning the Manager. Today we're joined by Tim Stevenson, Fund Manager of the Henderson Euro Trust, which invests in small and medium-sized companies on the continent. Tim, thank you for joining us. The first 3 months of the year saw some volatility in stock markets, including a global sell-off. Do you still maintain your positive outlook on Europe?
There's change, kind of constant change, and I'd say the big things that have changed this year is that, or one of the bigger things is certainly the increasingly aggressive rhetoric from Trump and America in terms of protectionism, which sounds to me like a lot of that's obviously directed at Germany. The euro has continued to be quite strong, the US dollar quite weak, so those two have certainly been an influence in the beginning part of this year. The actual sell-off when it came at the end of January, to some extent I think had been waiting to come for quite some time, because we'd seen interest rates drifting up at the long end, so bond yields have been rising. And in spite of that, equities were still storming ahead in the beginning of January. So the markets were looking quite overbought, and we were a little bit nervous, which is why we were not using much of our borrowing facility at the end of January. We were just basically keeping our powder dry because we wanted these markets to calm down a bit. But broadly speaking, the other underlying features, the good earnings growth in Europe continues to come through, the valuation is still quite attractive, and the European economies will continue to have another good year in 2018. So actually the European economic situation is not looking too bad. The other factor, long answer, but the other factor that I would mention is we've now got a German government being formed, a coalition government, that will be settling down in the course of March. We've had the Italian elections, which were more of a protest vote in the same way as we've seen in the past. But to some extent, at least at the moment, people are putting that down to quite a lot of frustration within Italy and within the Italian electorate for their leaders, if you like, for their political leaders over the last 10 years. So I would put that down more as a sort of specific Italian frustration rather than necessarily a revival of sort of anti-European feeling.
Has there been any significant activity in the first 3 months of the year in relation to the Trust's underlying assets?
No significant activity. The one thing that we have done is we have started to utilise more of our existing £20 million borrowing facility. So we have been using more of that. We always said it was our intention to be looking for a period of market weakness to utilise our borrowing facility. We are doing that, but in a fairly cautious manner because the markets continue to be quite volatile in the short term. So what we're actually doing is just utilising the weakness that we're seeing in the markets to continue to build up the position in really good quality companies, which we have held for some time, which we know very well, which we know have got good returns, and then applying that important aspect of patience to our holdings. We don't know when these markets will go better, but we feel they will, and that's where our patience comes to play.
Sentiment in Europe has already been poor for quite some time. How much of that might already be reflected in low valuations?
It's always a very difficult question. I mean, it's almost become a kind of global pastime sort of to criticise Europe, and indeed, there are plenty of things which can be criticised, and we've been critical of them ourselves as well. But the fact of the matter is that European companies are run in a much more long-term nature and aiming for sort of long-term, good, consistent, steady returns. And frankly, when you look at the numbers, they've actually achieved that. So none of that has actually been given credit. So there's not this same obsession with shareholder value. If there's some available cash, just quickly do a buyback and boost the share price kind of thing. It's much more of a long-term nature. And when you look at the valuation criteria of Europe and the valuation metrics, relative to other markets, Europe is looking pretty interesting here. Relative to the growth that European companies are seeing, both in 2017 and again predicted or expected in 2018, that growth looks like it's going to come through. It's looking pretty good. And then when you look at the valuation relative to bond markets, then the European markets are at a very interesting level. I mean, you're seeing dividend yields of between 2.5% and 3%, compared with a 10-year bond yield in Germany at the moment, currently trading at 0.7% dividend yield. So actually, from most of the valuation metrics, an awful lot of the bad news, you could argue, is actually already in the price. But if you want to take that attitude, you've got to make sure you're a patient investor, because there will be short-term volatilities we've seen already this year.
Tim, thank you for your time.
Thank you.